All right. Good morning, or good afternoon, traders. Today is Friday, October 24th, 2025. This is You've Got Options for Income Navigator. Today, we're going to start with the trade tracker. So this is the tracker that I use to track my short SPY put campaigns along with some other trades that I do in the Income Navigator. And I'll just go quickly over things that I've done so far this week. So this week on the short SPY put campaign, so we're looking at the exit dates, and the exit dates are the 20th, the Monday, Tuesday, Thursday, and today. So this week I closed out 4 trades. As you can see, I closed them out. I think only one of them hit 50%. All other ones hit between 45, 46, 44%. I just wanted to keep things moving along a little bit. Really makes no sense to continue to hold positions if premium kind of slowed, and maybe that has something to do with the overall volatility remaining slightly elevated in the markets. But it seems like on the shorter end of the curve, premium kind of became a little more sticky. So what I did was, instead of waiting for the next 20, 30 cents, maybe even as much as, in some cases, as much as 60 cents or whatever that number is, I decided to take off some of the trades early and open up some new trades with similar strikes. And this is what I mean. I closed out 617, or let's go to Monday. So Monday I closed out 619, and then I opened on the Monday 619 strikes. So as far as notional leverage go, I didn't take any more notional risk. I just exchanged one 619 put for another, and I exchanged from one duration to the next. So I closed out a trade that had 30 something days, and I opened a trade that had 70 days. And then I did the same thing with 620. I closed out 620, opened a 618. So notional didn't really change a whole lot. What did change was the trade that I closed out today. I closed at a 595 strike. I closed out a 595, and I opened a 640. Right. So, and this is in the same expiration. This is December 31st, and I opened a 640. Right. So as far as notional, I went from 595 to 640. But overall, what I'm looking at is my total notional value of all trades that are open. You can see it's 493, and it's reflected on my sheet here. Right. So my total notional is 493. And right now, the net lick is at 164. Right, so that takes me to about 3x leverage. Right, if I compare notional value of all of my outstanding positions compared to net lick, it's about 3x, which is fairly aggressive, and I would like to stay there. About 3.5x, maybe 3.8. That's already kind of a little more aggressive than I would like it to be. Again, this 3x notional leverage tells me that if the market was to dump, I cannot, in this account, with a net liquid of 164,000, I cannot take an assignment on all of these tranches. Given that if the market should start to dump, my net lick is going to drop, I definitely cannot take assignment on all of these positions. So I have two choices. And we talked about this very briefly when we were looking at covered strangles in TLT, that if I cannot take assignment because I don't have enough net lick to do it, right? We don't want to go and borrow on margin to take shares. I can possibly do two things. Number one, I can stop out of a trade for a loss, right? Remove the pain. Or if I was willing to take an assignment and sell a covered call, let's remember that a covered call has the exact same risk profile as an in-the-money short put. right? So if I was willing to take an assignment on any one of these tranches, right, I can continue to roll an in the money short put, which will be equivalent to me holding long shares and a short call against those shares, or a covered call, right? Hopefully that makes sense. So you kind of have to think for yourself, right? Which tranches are you going to get assigned and fully pay for the shares? Which tranches you're going to do a synthetic covered call, right? By rolling an in the money short put, or which tranches are you going to completely flat out just stop, take a loss, and maybe wait for the market to settle in. There is no right and there is no wrong way to go about it. You need to understand your situation, and according to your situation, you need to figure out what is the best way to go about any of these trades. All right, so that's what I did. I closed out 4 positions, and I put on, this week I put on 3 new positions, right? On the 1020, 1022, and 1024. And now I have 8 positions in the mix. My notional leverage is about 3x. Can I put one more on Monday? I can, right? As long as, again, it's not about the number of tranches that I have on. It's about my notional leverage. I don't want to go above, 3.5, 3.8. That number is also very discretionary. You can say, hey, I could leverage, to 5x and I'm comfortable with it. That's totally fine, right? But you have to know your situation and, plan and execute trades accordingly. So that's for the short SPY put campaign. For this campaign that I'm running, this is in the very early stages. I haven't really posted much about it, but the idea here is to hold 4 tranches of short SPY puts. These are entered at 28 DTE, and I have 28, 21, 14, and 7. So they are 7 days apart, right? And then when one comes off, next one comes on. So there's only 4 tranches. If one of them gets assigned, I will have 3 tranches of the short puts and deal with the assignment by selling covered calls, or maybe holding it for longer term, or maybe still considering, again, taking an assignment to sell covered calls will put me right back into a at the money short put risk profile. Then I just need to consider, do I want to spend settled cash to take assignment? The only one reason I could possibly think of why I would want to take an assignment instead of rolling an in the money short put is if there is a dividend, a special distribution, or something along those lines, or if I wanted to, have the voting rights and tell my kids that I'm going to a shareholder meeting to tell them who's boss. But other than that, right, I can just continue to roll my in the money puts, and that would be an equivalent to holding shares and selling calls against it. All right. And in the Income Navigator, so as far as the bear traps, and I'm going to look to put one on today. I had one rolling off, I think, next week. Yeah, this was October 31st expiration, and I closed it out yesterday because I was able to actually sell it for an additional credit. Right, this was trade 3260 for those that want to hop on Discord and take a look at. I mean, there was really no adjustments. There was nothing going on. We put the trade on for $1.65, I believe, initial credit, and then I took it off for another 50-cent credit. Right, we gave me a total credit for the trade, $215 on about $3,835 worth of risk, which was about a 5.61% return on margin in 29 days. Right, so that's the only trade I had come off this week. For hedged income trades, I had one trade that closed out yesterday right after the close. And, these trades right now, they look, or, the total P&L looks much better than what it really is, because we're not accounting for any of the long-term put debit spreads that will start to actually get recorded, I think, inside of the next 30 days is the first set of put debit spreads that are going to expire. So these P&Ls, right, if I closed out a position with a P&L of $2,210 profit, right, this is not all of the profit that I'm going to keep, because the put debit spread that's going to expire worthless, it was paid for partially by this initial credit of 2250 times 2, right? So there are going to be some losses realized on those put debit spreads, but in the end, the big picture, my P&L from the short naked puts that are closer in time has to be greater than all of the losses of the put debit spreads. And in the event that those put debit spreads at some point in time will be sold, right? They will get sold to finance any adjustments on the naked puts, right? So essentially, I will realize a profit on some of those put debit spreads because they do have some extrinsic value until they expire, right? So we'll see what happens there. I mean, this is also, I'm not sure if I'm going to continue to record these trades this way, because the template that I shared earlier in the week, I can use this template, right? Every single transaction will have its own line, right? So if I'm buying a put debit spread, one line is going to go for the long leg, one line is going to go for the short leg, and the third line is going to go for the naked puts that I'm selling against those put debit spreads. And over time, right, I will have a bunch of put debit spreads will stay open until they start to come off. So if I'm closing them for a profit, right, I'm harvesting that extrinsic value, it'll be recorded and I'll be able to keep track of it that way, which essentially is the same exact thing as just recording these trades individually on this spreadsheet. In summary for this spreadsheet, right, I'm just keeping track of the short SPY put campaigns, trades that have come off in the hedged income trade campaign. And again, these numbers look a little bit too good right now. And once the put debit spreads start to get recorded, these numbers are going to get reduced. But overall, nothing to get super excited. Just a regular, maybe it's a 2.5 or a 3% month or something like that. If you want to take a look at, let's go back to this spreadsheet. So I know Jeff had some questions about the trade tracker, and for those that do want to use something like this, similar, or this specific trade tracker, if you want to modify it in any way, shape, or form, you could just go to File and make a copy, right? And then you can go and do whatever you want to it. What I did was, as you can see, these darker shaded columns, right? This is where this spreadsheet has to do some math and figure out things for you. You could look inside these cells and say, well, there's no formulas here. And yes, there are no formulas. The formulas are in the header. And once certain information is populated in these white cells, it's going to do the math or whatever it has to do inside of these darker or shaded columns. Let's just do an entry as an example, just to show you how this works. As long as you don't change the formulas in the header, right? There's some formulas, and I'm actually rewriting some of these formulas right now to do to add some more functions to it, right? And once I do that, I'm going to update this spreadsheet that I shared with everyone. This is going to be kind of like a living document where I'm going to be able to add things to it. And then if you want to come back here and grab some stuff and add it to your spreadsheet, that's totally fine with me. But let's just assume, let's say we put on the trade today, right? Today is 10/24. So let's say I did a sell to open. I sold a put in 12/31 expiration. This is my short SPY put campaign, right? So, and the strike for today's put was 640. Let's say I did one lot and the price I collected was $6.45. So as you can see, right, as soon as I put in 645, this thing knows how many days we have until expiration, which is DTE. This tells me also how much time I have until expiration. So on Monday, this is going to show 65, and this is going to continue to stay 68. Right, just looks at the difference between expiration and entry, and this is going to look at the difference between expiration and today, whatever today is. Right, it's going to automatically populate a credit. This is what I collected, $645. It takes 645 times one lot. And it also has a status for this trade as open until I put in the close date. Closing transaction is going to be a buy to close and the price. And if there is no price, if I'm going to, for example, if I was to hold this trade until expiration, right, I would go and put in, I don't know, let's just say at some point in the future, this can be, let's say November 13th. Right, this is going to be, or let's say if on the day of expiration, which is 12/31, right, at 12/31, I let it expire. The price is 0, so it knows that there was no debit. My P&L for this trade was 645, so I collected 645, and that's what I kept. It figures out my P&L per day, and it changes the status of this trade to closed. Right, so you don't need to change anything inside of these gray columns. The formulas are in the header, right? And it's very easy to screw things up. So what I do normally, if you made a copy of this sheet, right? For example, you duplicated and you want to track, for example, like I started a new campaign in TLT. Right, so this is, I made a copy. I'll call this TLT, right? And as I said, I'm going to keep tabs on each underlying, right? So TLT is going to have its own tab, and everything I do in TLT will stay within this tab, right? Like I don't want to open a new tab for every trade because then you just have too many tabs. But so, but you could do whatever you want. If that makes more sense or if that's easier for you to track, totally fine with me. I'm going to keep tabs for every individual underlying, right? So in TLT, let's say I go and I delete all this stuff here, and then as you can see, I just deleted all of this information, but these headers, there's no formulas in the headers. That's what Jeff was saying. So here you have the formulas. Here you have the formula. So you don't need to write inside of these cells. Yes, it looks like there's no formulas, but the formulas are in the header. Right? So what I also do is I will highlight two of these, right? The darker shaded ones, and I'll right click on it and I go to protect range and I'll protect it from myself, right? So what happens is if I, for some reason, start to type in, it won't allow me to do it unless I say okay, right, and make the change. If I start typing here for some reason, it says, hey, you're trying to edit the part that's protected. I'll go cancel. And that's how this range stays protected, right? So I know not to put anything in the, and then I can also do the same thing, not to screw up these formulas by accident or delete them by accident. I will highlight the header row and then I'll just go and protect. Again, I am not an expert in this. If you know a better way of doing things, please let me know. Otherwise, this is how I do it. Right, so hopefully this makes sense. Right, and for TLT, let's say, what was the trade in TLT yesterday? And this is the way I would do it. So yesterday's date was 10/23. I sold to open a put So if I started to input some information and then I forget, I continue, I put the, let's say the strike or whatever, it's going to tell me that I'm missing something. I'm missing expiration. So I need to go and do the expiration. And the expiration the on the TLT that I did yesterday was 1029. Oops. Expiration was 1029. The strike was 91, 1 unit, and the price was, 25 cents. Right, so this thing knows now I had 6 DTEs when I entered. There are 5 days left until expiration. Whatever the outcome, we're going to record the outcome here next week. If we are assigned on this 91, we'll take the shares, right? So I'll just go, let's say, on 1029. If I get assigned, I do need to record the outcome. Either I'm expiring this trade, if it's going to expire out of the money, if TLT is above 91. Either I'm going to buy to close, if I'm going to buy it back for a penny or more. If it's at 0, it expires worthless. Or if I'm assigned, right, it's going to record it as closed. It's also going to assume that once you get assigned, there's no buyback, there's no price to buy it back. I get to keep the $25. And then once I get assigned, right, I will have to go in whatever the following day, or whatever you can use the assignment day, that's totally fine too, I think. Right? And our opening transactions, we need to record the purchase of these shares. Right? You can probably do buy to open. I'm not really sure, or we can do assigned stock. There's no expiration date. There's no strikes. There's definitely units. How many shares? 100 shares. What was the price? The price, and I probably could go back and figure out how to do, once I get assigned, I'm going to have this spreadsheet look up what was I assigned, how many shares, and then figure out the price or the lots, but it's just much simpler to do it, I guess, the way I'm doing it. So it's 100 shares. I get assigned at the strike price, which is 91. Right, so there's no days until expiration. There's no expiration, but the trade is open. So anytime I look at this spreadsheet, I know, what do I have going on in TLT? What do I have open? I have open 100 shares of stock. And then if at some point, like early in November, I'm going to guess that sometime, let's say November 6th. I don't know the date, but we'll come back and figure out what the date when it's time, right? November 6th, for example, if there's a dividend payment, right? I'll get a payment. The units is going to be 100. I don't know, maybe the dividend is 30 cents. Right, and here you can also, you don't have to, right? Because it's not a really closing. Dividends is just once you get paid, it records as credit. And maybe I'll also automate this and make it that if there's a dividend here, it'll automatically auto-populate into the date of this dividend, which, whatever the dividend date is. And then it records it as closed because it's really not a transaction. We're just recording a payment that we're collecting, right? But it's going to add to the P&L. And then over time, you can track. There's no dashboard. I'll add dashboard to it, but it'll track your total P&L, right? Your total running P&L, cumulative P&L. Right, so something like that. And then it's going to, over time, hopefully, look something like this. Right, this is a TLT that's been running for, it's been running for, I think it's been running for 297 days. Right, and then here I have a little bit more information. Right, it looks at today's price, figures out the unrealized profit in the shares, It figures out all of the P&L in the covered short strangles, and then it draws up what the return is, projected annual return, and then a little graph to show how the P&L was changing with every date where we recorded something. So if you really think about this trade is not, it's not something super exciting. It's not something that, you're going to triple your money. This is not a get rich quick type of deal, right? But this trade also takes maybe, I don't know, an hour a month, if maybe even less. I mean, I don't know how much time you would spend on checking in to see if your if your strangle closed. If it did, do you need to open a new one? Did you record dividend? How much time you do spend on this trade? But if you can make, between 14 and 15% holding on to shares, and, TLT didn't do a whole lot. It's not a super volatile name. And, I don't know, S&P is up probably around the same. So you can say that, oh, this is the same as, just buy and hold. I guess you can make the case for it, but I don't, I think that it has a little less volatility compared to just buy and hold. I don't think that this trade was at as much drawdown. It wasn't at as much drawdown back in April. But if you really want to make the case for why this is better, because even though you would have to put up 45,000 of settled cash to do this trade, if you do it in the portfolio margin account, to hold 500 shares of TLT, it's way less, right? It's like $5,000 or $6,000. So the return of $6,000 on running P&L on what's currently required to hold this trade is close to 100% return. Right, so you can make the case why this is better than just buy and hold. All right, let's. So hopefully this kind of gives you a little bit better insight about how to use this spreadsheet. And again, this isn't the only way to do it. You can use it any way you want, but and you can record whatever. Right, you can take almost any trade. It doesn't have to be a wheel trade. It doesn't have to be covered calls, poor man covered calls, rich man covered calls, whatever you want. Every line is a transaction for every one leg. If you're doing a call credit spread, you can record your long leg, your short leg, and then assuming you put accurate information, it's going to give you your total numbers, whatever numbers you want to see. All right. Now we can go and look at, we're going to look at a bear trap trade. I'm looking to put on a bear trap trade, and I'm going to share my Optionet Explorer. We'll look at a trade, we'll try to get in, and then we're going to move on about our day. So this is what the TLT, the one lot that I started yesterday, looks like, and we'll see what happens next week. We get assigned at 91, great. We'll sell another strangle around it, and we'll build out a position that way. 4 other wheel trades that are in the running. This is the Home Builders ETF. This trade is currently showing a 80% of max profit with 14 days. I think this is not a terrible idea to, take the profits and set up a new trade. I know Tom set up another trade in the same underlying, I think, yesterday, which is an awesome idea as well. So just to keep things moving, I don't think that, I could be wrong, and you don't have to agree with me, but if I can grab 80% of max profit and then wait another 2 weeks for the last 30 cents, I think this premium is going to be way stickier than if I was to buy this back and then go out a couple of weeks and sell something maybe a little bit closer, right? Like a 105 maybe. As long as you're willing to be net long 38 shares of this underlying, I think it's a fine trade to close out and extend your duration and take in an additional credit, potentially reducing your cost basis if you were to take an assignment on this trade. What else? This is Altria. This is a trade that's been on for 2 weeks. The underlying is kind of doing a whole lot of nothing, so we're just going to leave that alone. CRWV. This trade has improved a lot relative to where it was just a couple of days ago or last week on Friday. So we're just going to hold. And, this one has 21 days. Again, if you want to talk about this risk graph is already looks like we're long shares and short a 115 call. If you were feeling the pain and you started to question why you're in this trade or for whatever reason, this is a great time to probably get out of this trade because the expiration, which is the November 14th, will cover the earnings. Earnings are coming up. I'm not sure the date. CRWV, I'm going to check right now. The date of their earnings is in 19 days. Right, so their earnings are on deck. They're coming. And November 14 expiration is going to be in that cycle. So if they do something terrible or the reaction to their report is going to be a negative one, this one could be a tough trade once again. So don't try to be a hero. Understand your situation and act accordingly. What else? ETHA. This is another one that is already looking like a long stock covered call. Also 21 days until expiration. This is equivalent of being 75 shares long of this underlying, which should technically move in line with Ethereum. I know that crypto is not having a great time right now. So I think that, longer term, I would like to own more than 100 shares. I don't have a position in ETHA as far as the underlying goes. So this was like a starter position. If I want to take assignment on the shares, I would sell another covered strangle around it. For now, I'm just going to see what happens to this in the money put. If it's still in the money, I may roll it out for an additional credit. If I can roll it for additional credit, I will take the shares and then figure out another covered strangle around it and potentially build a position similar to what I'm holding in the TLT right now. And as far as the old TLT trade, this one is going to expire next week. I'm not sure what's going to happen with the 92 short call. If TLT is above 92, I'm probably just going to let the shares get called away. If we're below 92 but above 85, the strangle is going to expire worthless. The 500 shares will remain, and I will sell another strangle and record it and update in my spreadsheet. All right. So this is the remaining bear trap. So this one is looking much better than it did just a couple of days ago as the market is now pushing higher. And this one has 28 days until expiration. It is 14 days in. And remember, I said that I'm going to set up these trades. I'm going to try to keep them 14 days apart. The reason why I say why I want to keep them 14 days apart, because every Friday, well, SPX has a lot of different expiration cycles. So a 42-day expiration cycle, if we break 42 into 14, we get 3 cycles. So I'm going to have 3 trades running in this campaign. They are going to be 14 days apart. So if I put on the trade today, it's going to have 42 days. The next trade is going to have 28 days. And I'll have 2 trades in this campaign. 2 weeks from now, right, what I'm going to put on today at 42, that's going to become a 28-day trade. This 28-day until expiration trade is going to become a 14-day until expiration trade. And then 2 weeks from then, right, this trade is going to have only This trade is actually going to expire. The trade that's going to be that was 28 is going to become 14. So they're just going to one is going to replace the other, right? One trade comes on, one trade comes off. So we are looking at 42 days until expiration. I'm not going to do anything super fancy. I don't really care so much about where the market is going, where, at all-time highs. The market is going to probably continue higher. I don't know, right? What happened in the last couple of weeks, I think there was more of a scare than actual reason to sell everything, right? The tweets started flying, and lots of market participants with the PTSD. What happened back in April when the tweets went off against China and the threats about 100% tariffs. We saw a major spike in volatility. The market was down as much as 15 or 20% or whatever that was. I think the market was very sensitive to a new round of tariffs on China, and we saw volatility spike to as high as 29 on the VIX without the market really taking a dive. So I think this was more of a scare. I don't know, where we go from here, but it seems like for now, the meeting with China is back on. So we're friends again, and the market is back to all-time highs. So without doing anything super fancy, I'm going to just try to look for a trade setup similar to what I normally do. And by normally, I'm going to look for a 50-point wide put credit spread. We're going to have to go somewhere around Delta 15 and see what we can find there. I don't know if it's going to be 60-50. The price is going to tell us. Let's get rid of this extrinsic column so that the things aren't so squished. So let's go and see if we can sell a 60-50 and then buy a put 5 strikes lower. That's not a 15 delta put. My apologies. Let's scroll up to where we find a 15 delta put. And that looks like 60. Let's see, it's 6,400 if we can find something there, right? I want to put this as far out of the money as possible. So 6,400, 6,350, right? This one is paying $395 to $405. Mid price is somewhere around $4. Does it mean that we're going to get filled at $4? Maybe or maybe not, right? But this is my targeted put credit spread. 6,400, I'm going to write this down. 6,400, 6,350, right? So that's my put credit spread. And now I'm going to scroll up and look to buy a put debit spread, and I want to spend about $2 on it, right? So I can't get too close at the money because I know the closer at the money I go, the more this put debit spread is going to cost, which means the more it's going to reduce this $4 credit that I'm looking to collect. Yet I don't really want to go too far, right, out of the money on that put debit spread, because the farther away this put debit spread, the smaller the trap is, and the more of a pipe dream it becomes, so to speak, because again, to catch the trap, it's just going to be pure luck. We can't time the market. There's nothing we can use to figure out where the market is going to be inside of the next 42 days to try to set up this trade in a way that is going to allow us to capture this bear trap profit, right? So it has to be as close at the money as possible without spending too much on it. So we're looking to spend around $2 on it, right? So maybe we'll go around Delta 35 and let's see what it goes for. So a 67.20, and then we'll go to 67.10. Right, that's going to reduce my credit from $4 to about $1.50. So this 10 wide is going for about $2.50. So if I'm willing to take a smaller credit up front, but give myself a little bit more room or trade a little bit closer to at the money, this is a fairly decent idea. As you can see, we don't have a whole lot of directional exposure to start. Sure, this is a bullish trade. Why? Because we have a positive delta. What else? If the market starts to slide, we have negative gamma, which means that it's going to negatively affect our delta, meaning it's going to work against us. If the market's going lower, our delta is going to increase. The lower the market goes, the more bullish this position is going to become, right? There is no risk to the upside. All of the risk is to the downside. If we were to take in a $165 or a $150 initial credit, that is the most we can possibly make if the price is going to be outside of the structure at expiration. The structure meaning inside of the put debit spread and the put credit spread, right? So 165 on or outside of the structure or in the tail, as we like to call it. If we are inside the structure at expiration, we'll make full value of this put debit spread, which is 10 points wide times 100 multiple. This put debit spread has a max potential profit of $1,000 plus the initial credit, so about $1,150. Right, we'll have a potential profit inside the trap of $1,150. And then if things go really, really bad, there's a lot of risk to the downside, but we're not looking to hold until expiration if the price is going to push through the trap, right? We're going to assume that if the market is selling off, something has changed, right? This bullish leaning position is not the right tool for the market that is not bullish. So on the way down, we have to realize that, hey, the market is telling us that our bullish assumption was wrong, and we need to preserve both mental and financial capital. And I like to use, you can use whatever you want, right? But I think if I take this trade off for a $500, maybe a $600 loss, it's still decent enough where, assuming that probabilities are going to hold up, it won't take too many winners to make up the lost ground, right? I don't want one loser to cost me 25 winners to get back to break even. I want my losers to be, they're going to be more than what I normally make in the tail, right? But maybe if I catch a couple of these trades in the trap, right, overall they're going to pay off some of the losers that I may take along the way. But this trade, we talked about this before. I don't want to go into an hour lecture about probabilities here, but you can see that our downside break even is down at about 63.90, let's call it that. And if we're going to use the delta of 63.90 to kind of give us an approximation of probability of profit in this trade, there's about an 85% probability that the underlying is going to be somewhere above. We don't know if it's going to be inside or outside the structure, but it's going to be somewhere above the downside break even. And we can take it one step further and use the delta to give us an approximation of a probability of touch, right? What is the probability of SPX touching 63.90, right? We just double the delta, which is about 30%. So there's about a 30% it's implied probability based on current implied volatility. If the market freaks out for whatever reason next week, that number is going to change. So don't take this, as a writing on the wall. This number is going to change with probabilities. Right now, based on today's implied probability, there's an implied probability of touch of 63.90, about 30%. If next week implied volatility is going to rise, probability or chances of this number being breached is going to increase. What does that mean? That means the delta on 63.90 is going to rise. If this delta goes from 15 to 30, that means probability of 63.90 being breached will go up to about 60%. right? So, but given information that we have right now, right, this trade has about an 85% probability that the underlying is going to be somewhere above break even, which is a really high probability chance that we're going to make at least the tail profit. And if we are lucky enough to capture the price inside the bear trap at expiration, we'll get a nice bonus. Most of the time, right? I don't know, 85% of the time, we're going to be just collecting the initial credit, and that's all we're going to make. There are going to be some times, like for example, the trade that I closed out yesterday, that is going to produce another credit, right, before expiration, and maybe we could take advantage of that. But most of the time, if the market just moves in the direction, right, where we have no risk or to the upside, we're just going to keep whatever we collect initially, and that's all we're going to make. All right, so this one's going for $1.55. You know, if you wanted to a little bit more credit, right, which means you want a little bit more reward, what does that mean? Well, you're going to have to take on a little bit more downside risk, which means you're going to take on a little bit more delta, which means you will have to trade a little bit closer, or you're going to have to move your debit spread a little bit farther out of the money, right? So if we go just a bit further out of the money, now the credit is 170, right? We moved the debit spread a little bit farther away, which means we have slightly lower probability of this put debit spread going in the money in exchange for a little bit more money up front, right? It's always a two-sided market. We're gaining something, but we have to give up something for it, right? We gain a little bit more credit up front, but we slightly reduced our probability of this put debit spread going in the money. I think I like it. 175, 160, right? Let's 180. I don't know what we're going to get for this trade, but if I was to put this on right now, and I'm going to do it, right? I don't send orders through Option Explorer. I'm just looking for a mid price. I'm going to go to Thinkorswim. And what I did here, I just went, right? And if I go to send without save, this will copy this order. And then I'll go to Thinkorswim and I will paste this order in the order entry. It's going to automatically populate so that I don't have to go and choose the strikes one by one. Right, this is a put condor that's going for, let's see, where's the mid price? The mid price is showing 170. I saw it as high as 180. So, you know what? Let me try 180 and we'll see if we can get it. So this is going to be to open, collecting a 180 for one lot. And 180 is a no-go. And that's okay, right? We don't expect, right, seeing the mid price at 180 doesn't mean that's where they're going to let me in. Right? So 180 is a no-go. I can say, all right, can you let me in at 175? Right? And I could just create a duplicate order. Yeah, I don't recommend doing that for anybody because if you duplicate an order and then you get filled on both, if you never had intention of holding a two lot, right, you just want to do cancel and send or cancel and re-send. Let's see if there's anything for 175 credit. Nothing for 175. I'm going to change the order from 175 to 170 and then we'll see what happens. So I'm going to cancel, replace from 170 to 175. See, the mid is jumping to one. All right, so 175 filled. Okay, So we're in for 175, and then I'm going to go and put the prices in, right? This is going to be my SPX, 5Ds bear trap, right? For 175 credit. And now we're just going to hold this. Hopefully the market is going to be somewhat stable. And if the market pushes way lower, if I'm down at any given time, don't care what Kramer thinks. I don't care what, nothing matters. The price is the only thing that tells the truth. So if we're down 500, 550, 560, 75, whatever, between 5 and 600 bucks, I'm going to take this trade off. Right? And maybe the price will push into the trap, fool me, get me out, and then come back, which is, not unusual. Something like this could happen. It is what it is. You just because, this is the last thing I'm going to say. Sometimes, right, we get down to a point where we need to stop, and then we saw the headlines and we think that something is going to happen, or whatever the case may be. Right? We choose to ignore our plan and not stop out. And then the next day or in 2 days or whatever, the market goes the other way and you say, man, I knew it. I knew it. Kramer is a million things, but you know what? He knows his stuff. And good thing that I didn't stop out because I would have been at a loss instead. Now it's at a break even and I could potentially make some money. That's all great. The problem with that is the very next time when the trade gets to a point where you need to stop out and you say, man, I remember last time, and let me go back and look at those headlines. Let me see what this guy or that guy, and then instead of going back up and working in your favor, it goes 4 standard deviations against you. Instead of a $500 loss, now you're looking at a $1,500 loss. Right? So that's why I say we don't know what's going to happen. You have a plan. If you're not comfortable taking a $500 loss, you should not be doing the trade, period. All right. So I think that's all I have for you guys. If you have any questions, you can find me and send a message on Discord. We talked a lot about, Discord, and we're trying to, keep the noise down. We're trying to do a better job at, moderating the channels. There are ways to do it. Use threads for replies to stay on topic. You can create new forum posts, right? Let's try to be mindful and let's try to keep it clean in the chat. If you have any questions, the chat room is always open. Ask away. Otherwise, have a good weekend. I'll be back next week. If you have any questions, on Discord we go. Have a good one. Take care, everybody. Bye-bye.